didn't happen all at once. There was no single headline that marked the turning point, no abrupt collapse that forced everyone to pay attention. Instead, it began quietly, almost invisibly, in scattered neighborhoods where for sale signs stayed up a little longer than expected. At first, sellers blamed timing. Then they blamed pricing. Eventually, they stopped blaming anything at all and simply waited. In the early years of the decade, the American housing market moved with a kind of momentum that felt permanent. Low interest rates, pandemic-driven migration, and a sudden rethinking of space pushed demand into places that had never experienced it before. Cities that once grew slowly began to accelerate. Suburbs expanded outward. Smaller metros, long overlooked, became destinations. Buyers arrived quickly, often with urgency, often with cash, and almost always with the belief that waiting would only make things more expensive. For a time that belief held. Prices climbed steadily, then sharply, then almost uncontrollably. In markets like Phoenix, Austin, and Boise, the pace of appreciation outstripped local income growth by a wide margin. Homes were no longer just places to live. They became financial positions, opportunities to lock in gains that seemed increasingly guaranteed. Bidding wars became routine. Inspections were waived. Appraisals struggled to keep up with contract prices that had already moved beyond what recent sales could justify. But markets built on speed are often vulnerable to stillness. By late 2022, the first signs of hesitation began to appear. Mortgage rates, which had hovered near historic lows, started to rise. At first, the increase seemed manageable, even temporary. Buyers adjusted their expectations slightly, recalculating monthly payments, stretching budgets where necessary, but the pace of rate increases didn't slow. It accelerated. Within months, affordability changed in a way that few had anticipated. A buyer who could comfortably afford a home at 3% interest suddenly faced a very different reality at 6%, then 7%. Monthly payments climbed dramatically, even if home prices remained unchanged. For many, the math no longer worked. The same income supported far less house. The same savings covered less of a down payment once higher costs were factored in. Quietly, some buyers stepped back. They didn't announce their exit. They didn't need to. Their absence showed up in the data first, in fewer showings, in longer days on market, in price reductions that started small but grew more frequent. Sellers noticed, but not immediately. Many were anchored to recent comparable sales, to the peak values that had defined the previous year. They adjusted slowly, often reluctantly, trimming prices just enough to signal flexibility without fully acknowledging the shift. In places like Austin, inventory began to build, not dramatically at first, but steadily enough to change the rhythm of transactions. Homes that would have sold in days now took weeks. Weeks stretched into months. The urgency that once defined the market began to fade, replaced by a kind of cautious patience on the part of buyers who remained. That patience changed everything. For the first time in years, buyers had options. They could compare properties, negotiate terms, request repairs. They could walk away from deals that didn't meet expectations, and increasingly they did. The psychological shift was subtle but profound. Housing was no longer something to chase at any cost. It became something to evaluate, to question, to delay. At the same time, sellers faced a different kind of pressure. Many had purchased or refinanced at historically low rates. They were locked into mortgages that, in retrospect, looked exceptionally favorable. Selling meant giving up those rates and entering a new financing environment that was far less forgiving. As a result, some chose not to sell at all, reducing the flow of new listings even as demand weakened. This created a market defined by imbalance, but not the kind seen during the boom. Instead of too many buyers chasing too few homes, there were now selective buyers facing a growing number of listings that didn't quite meet their expectations. Prices didn't collapse immediately because supply was still constrained in many areas, but they stopped rising. In some cases, they began to drift downward. The change was most visible in markets that had experienced the fastest growth during the boom years. These were places where price increases had been driven less by long-term fundamentals and more by sudden inflows of demand. When that demand slowed, there was little to support the elevated price levels. In Boise, for example, the The surge in home values had far outpaced local wage growth. During the peak, out-of-state buyers, particularly from California, played a significant role in pushing prices higher. When those buyers retreated, due to higher borrowing costs, changing economic conditions, or simply shifting preferences, the market lost a key source of demand. Local buyers, constrained by income, were unable to fill the gap. A similar pattern emerged in parts of Arizona and Nevada, where population growth had fueled rapid development. New construction projects, planned during the height of the boom, continued to come online even as demand softened. Builders responded with incentives, rate buydowns, closing cost assistance, upgrades, but these measures could only do so much. The underlying issue remained affordability. Affordability, in many ways, became the central story of the market. It wasn't just about prices or rates in isolation, but the relationship between the two. Even in areas where prices had begun to decline, higher mortgage rates offset much of the benefit. Buyers waiting for a return to previous conditions found themselves in a different kind of market altogether, one where neither prices nor financing terms aligned with past expectations. And so, the exit continued. It wasn't dramatic. There were no lines of sellers rushing to offload properties, no widespread panic that forced rapid liquidation. Instead, it was a gradual withdrawal of participation. Fewer buyers entered the market. Fewer offers were made. Transactions slowed, not because homes disappeared, but because agreement became harder to reach. Real estate agents described the shift in simple terms. Conversations changed. Where clients once asked how quickly they needed to act, they now asked whether they should act at all. Where urgency once drove decisions, hesitation began to dominate. Buyers wanted certainty in a market that no longer provided it. This uncertainty extended beyond housing itself. Broader economic conditions played a role, shaping expectations about income, employment, and future costs. Inflation, which had surged alongside the housing boom, began to affect everyday expenses. For many households, the margin for taking on additional financial commitments narrowed. Buying a home, once seen as a stable investment, now carried a different set of risks. In this environment, waiting became a strategy. Not waiting indefinitely, but waiting long enough to see how conditions evolved. Buyers watched interest rates, tracked price changes, monitored inventory levels. They paid attention to signals that might indicate stability or further decline, and in doing so, they contributed to the very slowdown they were observing. Markets, after all, are shaped as much by expectations as by fundamentals. The shift became easier to see when it was no longer confined to isolated transactions. What had started as a subtle change in buyer behavior began to appear across entire regions, repeating the same pattern with only slight variations. Homes lingered, price cuts followed, listings expired and quietly returned weeks later, often at lower numbers. There was no single moment when the market turned, but there were many small moments that, taken together, pointed in the same direction. In Austin, the change unfolded in layers. During the height of the boom, the city had absorbed an extraordinary wave of demand. Technology firms expanded, remote workers arrived in large numbers, and investors followed closely behind. Prices rose quickly, often disconnected from local income levels. At the time, the justification seemed clear: growth would continue, and housing would remain scarce. But as borrowing costs increased and hiring slowed across parts of the tech sector, the assumptions that supported those prices began to weaken. The first adjustment came through incentives rather than outright price reductions. Sellers offered concessions. Builders reduced mortgage rates through temporary buydowns. These measures were designed to preserve headline prices while addressing affordability indirectly. For a brief period, they worked. Transactions continued, though at a slower pace, but incentives have limits. They can encourage a hesitant buyer, but they cannot create one where none exists. By mid-2023, the limits became more apparent. Inventory levels rose, not because of a sudden surge in new listings, but because existing homes remained unsold for longer periods. Days on market extended beyond what sellers had come to expect. A property that might have attracted multiple offers within a weekend now required several weeks just to generate consistent interest. The difference was not only numerical, it was psychological. Sellers began to recognize that the conditions they had relied on were no longer present. Phoenix followed a similar trajectory, though its dynamics were shaped by different forces. The city had long been a destination for both retirees and investors, drawn by relatively affordable housing and steady population growth. During the boom, that demand intensified, pushing prices higher at a pace that outstripped historical norms. New construction expanded rapidly to meet it, with entire subdivisions planned under the assumption that buyers would continue to arrive. When rates rose, the impact was immediate. Investor activity slowed sharply, particularly among those who relied on financing rather than cash. At the same time, traditional buyers faced the same affordability constraints seen elsewhere. The combination left a gap in demand that was difficult to fill. Builders, with projects already underway, responded by increasing incentives, but like in Austin, these measures addressed symptoms rather than causes. In some neighborhoods, the adjustment became visible in more concrete ways. Price reductions were no longer occasional, they became part of the listing strategy. Homes entered the market at optimistic values, then stepped down incrementally until they aligned with what buyers were willing to pay. This process took time, and during that time, inventory continued to build. Las Vegas experienced its own version of the slowdown, shaped by its history as a market prone to cycles. The memory of the late 2000's collapse remained part of the local narrative, influencing both buyer and seller behavior. During the recent boom, prices climbed rapidly, supported by migration and investment demand. But as conditions tightened, the pace of transactions slowed, and with it, the sense of inevitability that had defined the market's rise. Here too, the shift was gradual. Buyers did not vanish overnight, but they became more selective. Properties that required significant updates or were priced at the upper end of the market faced longer selling times. Sellers who adjusted quickly found buyers, those who did not often waited. The difference between these outcomes reinforced a new reality. Pricing was no longer a formality, it was a negotiation. Further north in Boise, the adjustment carried a different tone. The city's rapid growth during the pandemic years had been one of the most pronounced in the country. Prices surged as out-of-state buyers entered the market, often with higher budgets than local residents. For a time, this dynamic sustained itself, with each new sale supporting the next. But when those external buyers pulled back, the underlying imbalance became difficult to ignore. Local incomes had not kept pace with home values. As a result, the pool of potential buyers was smaller than it appeared during the boom. When demand slowed, there was little buffer. Listings accumulated, and price reductions became more frequent. The process was not chaotic, but it was persistent, reflecting a market searching for a new equilibrium. In each of these cities, the details differed, but the underlying pattern remained consistent. Rapid growth had been followed by a period of adjustment, driven primarily by changes in affordability and expectations. The speed of the initial rise left little room for gradual correction. Instead, the market moved from acceleration to hesitation, skipping the intermediate stages that might have softened the transition. What made this period distinct was not the presence of decline, but the manner in which it unfolded. There was no single trigger that forced a rapid downturn. Instead, multiple factors aligned to reduce demand incrementally. Higher interest rates increased borrowing costs. Economic uncertainty affected household confidence. Remote work trends, which had once expanded the range of viable locations, began to stabilize, reducing the urgency to relocate. At the same time, sellers faced constraints that limited their ability to respond quickly. Many were tied to low mortgage rates secured in previous years. Selling meant replacing those rates with higher ones, often for a similar or even less desirable property. This created a form of inertia within the market, where potential sellers chose to remain in place rather than participate in transactions that felt unfavorable. This inertia had a stabilizing effect on prices in some areas, preventing sharp declines, but it also contributed to reduced activity, reinforcing the sense that the market had entered a period of pause. Transactions continued, but at a lower volume. Each sale carried more weight, serving as a reference point for subsequent negotiations in a market with fewer clear signals. The role of builders during this period added another layer to the adjustment. Unlike individual sellers, builders operated with different constraints. Projects were planned years in advance, financed through structured arrangements that required completion and sale. As demand slowed, builders could not simply withdraw inventory from the market. Instead, they adapted through pricing strategies and incentives, often competing directly with existing homes. This competition placed additional pressure on resale properties, particularly those that lacked the features or incentives offered by new construction. Buyers, aware of their options, compared not only prices but also financing terms, warranties, and potential upgrades. In many cases, new homes presented a more attractive overall package, even if their base prices were similar. As a result, the resale market faced a more complex environment than during the boom years. Success depended not only on location and condition, but also on how a property was positioned relative to competing inventory. Sellers who recognized this dynamic adjusted accordingly. Those who did not often found themselves waiting. Throughout this process, data began to confirm what individual transactions suggested. Metrics such as days on market, price reductions, and inventory levels shifted in ways that aligned with the broader narrative. The changes were not uniform across all regions, but in the markets that had experienced the most rapid growth, the pattern was difficult to overlook. Yet even as these indicators pointed toward a cooling market, the absence of a sharp decline created a sense of ambiguity. Was this a temporary adjustment or the beginning of a longer-term shift? The answer depended on factors that extended beyond housing itself, including monetary policy, employment trends, and broader economic conditions. For buyers, this uncertainty reinforced caution. Entering the market required not only financial readiness, but also confidence in future conditions. Without that confidence, waiting remained a rational choice. Each month of stability or decline provided additional information, shaping expectations about where prices might settle. For sellers, the challenge was different. Timing became less predictable. The assumption that demand would absorb available inventory no longer held. Instead, success depended on aligning expectations with market realities, often sooner than anticipated. Delayed adjustments tended to extend selling times rather than improve outcomes. By the time the slowdown became widely acknowledged, it had already been underway for months, not as a dramatic shift, but as a steady accumulation of small decisions made by individual buyers who chose, for their own reasons, not to move forward. Each decision on its own was unremarkable. Together, they formed a pattern that began to reshape the market in ways that were difficult to reverse. What made this different from previous housing cycles was the absence of urgency on both sides of the transaction. Buyers were no longer competing against one another with the same intensity, but sellers were not under immediate pressure to sell either. This created a kind of standoff, where activity slowed not because one side dominated, but because neither side was willing to move quickly. In markets like Denver and Salt Lake City, this balance was particularly evident. Both had experienced strong growth during the earlier expansion, driven by population inflows and relatively high incomes. Prices had risen accordingly, supported by demand that appeared stable and long-term. But as affordability tightened, even these markets began to show signs of strain. Buyers in these areas were often more financially stable than in some of the faster-growing regions, but that stability did not translate into unlimited purchasing power. Higher interest rates affected them in the same way, reducing the size of loans they could comfortably carry. The difference was that, rather than stretching beyond their means, many chose to wait. The decision was less about inability and more about preference. Waiting, in this context, became a form of participation. Buyers remained engaged, monitoring listings, attending open houses, and tracking price movements, but they delayed commitment. This behavior contributed to a market that appeared active on the surface but produced fewer completed transactions. Interest existed, but it did not always convert into action. Sellers responded in varied ways. Some adjusted quickly, pricing their homes in line with current conditions and accepting offers that would have seemed low just a year earlier. Others held firm, anchored to past valuations, and unwilling to accept what they perceived as a loss. These differing strategies created a wider range of outcomes, with similar properties selling at noticeably different prices depending on timing and expectations. This divergence added another layer of complexity to the market. Comparable sales, which had once provided clear guidance, became less reliable as indicators of value. A home that sold quickly at a reduced price might coexist with another that remained listed at a higher level for months. Buyers, aware of these discrepancies, became more cautious, using them as justification to negotiate more aggressively or to wait for further adjustments. In parts of Florida, particularly in cities that had seen significant migration during the pandemic, the slowdown took on additional dimensions. Rising insurance costs and concerns about long-term climate risks began to factor more prominently into buying decisions. These considerations were not new, but they carried greater weight in an environment where affordability was already stretched. For some buyers, the combination of higher borrowing costs and increased ownership expenses shifted the calculation entirely. Renting, once seen as a temporary alternative, became a more viable option, at least in the short term. This shift did not eliminate demand for housing, but it redirected it, reducing the number of people actively pursuing home purchases. Meanwhile, in California, the dynamics were shaped by a different set of constraints. High home prices had long been a defining feature of the market, limiting accessibility even during periods of low interest rates. As rates rose, the impact was amplified, pushing affordability further out of reach for many potential buyers. In these markets, the slowdown was less about a sudden change and more about an extension of existing challenges. Transaction volumes declined, not because demand disappeared entirely, but because the pool of eligible buyers became smaller. Those who remained often had significant financial resources, allowing them to navigate the market with greater flexibility. However, even among this group, caution increased. The role of investors during this added another important element. During the boom, investor activity had been a significant driver of demand in many markets. Properties were purchased not only for occupancy, but also for rental income or anticipated appreciation. As conditions changed, the assumptions underlying these investments were reassessed. Higher financing costs reduced potential returns. Slowing price growth altered expectations about future gains. In some cases, rental markets became less predictable, further complicating the equation. As a result, investor participation declined in many areas, removing a source of demand that had previously supported higher prices. This withdrawal was not uniform, and it did not lead to widespread selling. Instead, it contributed to a reduction in new purchases, reinforcing the broader trend of declining activity. The absence of investors was felt most acutely in markets where they had been particularly active, amplifying the effects of reduced demand. At the same time, the broader economic environment continued to influence behavior. Employment remained relatively stable in many regions, preventing the kind of forced selling that had characterized previous downturns. Without a significant increase in distressed sales, prices adjusted more gradually. This gradualism contributed to the sense that the market was cooling rather than collapsing. However, gradual changes can still produce significant outcomes over time. As months passed, the cumulative effect of reduced demand became more apparent. Inventory levels, while not overwhelming, were consistently higher than during the peak. Price reductions, once notable, became routine. The expectation of quick sales faded, replaced by a more measured approach. For buyers, this environment offered both opportunities and challenges. Greater selection and negotiating power made it possible to secure better terms, but uncertainty about future conditions made decision-making more complex. The question was no longer simply whether a property was desirable, but whether it would hold its value in the years ahead. For sellers, the adjustment required a recalibration of expectations. The strategies that had succeeded during the boom were no longer effective. Marketing timelines extended. Pricing required greater precision. Flexibility became an asset rather than a concession. Throughout this process, the narrative of the housing market continued to evolve. Early in the slowdown, the focus had been on rising interest rates and their immediate effects. Over time, the emphasis shifted toward longer-term considerations, including demographic trends, regional economic conditions, and the sustainability of previous growth patterns. These factors varied widely across markets, ensuring that the slow exit did not unfold in exactly the same way everywhere. Some areas stabilized more quickly, finding a balance between supply and demand at lower levels of activity. Others continued to adjust, with prices and transaction volumes moving downward over a longer period. What connected these experiences was the underlying shift in behavior. Buyers, once driven by urgency, now operated with caution. Sellers, once confident in their position, now faced a more uncertain environment. The interaction between these perspectives defined the market, shaping outcomes in ways that were often subtle but consequential. By the time the market reached this stage, the shift was no longer subtle. It didn't arrive with panic or headlines, but it was visible in the way time began to stretch. Listings stayed active longer, decisions took more consideration, conversations changed. The urgency that once defined the housing market had quietly disappeared. What replaced it was something slower, more deliberate, and far less predictable. In many of the markets that had led the boom, prices no longer moved with the same confidence. They didn't collapse in dramatic fashion, but they stopped climbing. In some areas, they drifted sideways. In others, they edged downward in small, consistent steps. It was not the kind of movement that draws attention overnight, but over time, it reshaped expectations. Buyers began to see time differently. Where waiting once carried risk, it now offered possibility, a better price, a more favorable deal, more options. This shift in mindset didn't require everyone to act the same way. It only required enough buyers to hesitate, and that hesitation, repeated across thousands of decisions, slowed the entire system. Sellers felt it first through silence. Fewer showings, longer gaps between inquiries, offers that came in below expectations, sometimes well below. The market was still functioning, but it required adjustment. Pricing, once aggressive, had to become realistic. Negotiation, once rare, became routine. In cities like Phoenix and Austin, the presence of new construction added another layer to the slowdown. Builders continued to deliver homes that had been planned during the peak. Unlike individual sellers, they couldn't simply wait indefinitely. They responded with incentives, rate buydowns, closing cost assistance, upgrades, but even these measures had limits. Because incentives can encourage a buyer, but they cannot create urgency where it no longer exists. The result was a gradual shift in leverage. Buyers gained more control over the terms of a deal. They compared options carefully, they negotiated, and when something didn't feel right, they walked away, not out of fear, but out of choice. This was the defining difference. The market wasn't being forced downward by distress, it was being pulled into balance by restraint. At the same time, the broader economic environment continued to shape behavior in quieter ways. Inflation had eased from its peak, but its effects remained. Everyday costs were still elevated, budgets were tighter, financial decisions carried more weight. And then there were interest rates. Even as they stabilized, they remained far above the levels that had fueled the boom. The idea of ultra-low borrowing costs began to feel like something from a different cycle. Buyers adjusted to this reality unevenly. Some accepted it and moved forward. Others waited, hoping for conditions that might not return in the same form. That divide mattered. Because a market does not need all participants to step back in order to slow, it only needs enough hesitation to reduce momentum. And once momentum fades, rebuilding it takes time. In places like Florida, additional pressures added complexity. Rising insurance costs and long-term climate concerns became part of the calculation in a more direct way. These were not new issues, but in a tighter financial environment, they carried greater weight. In higher-cost states like California, the challenge remained affordability, but now at an even sharper level. Fewer buyers could qualify, Those who could were more selective. Transactions still happened, but with less frequency and more scrutiny. Across all these regions, one pattern remained consistent: the absence of forced selling. Unlike previous downturns, most homeowners were not under immediate pressure to sell. Many held low mortgage rates secured during earlier years. Selling meant giving up those rates and stepping into a more expensive borrowing environment. As a result, many chose to stay put. This decision stabilized prices in some areas, but it also slowed the market further. Fewer sellers, fewer buyers, fewer transactions. A system not collapsing, but tightening. And within that tightening, a new kind of balance began to form. Not the fast-moving equilibrium of the boom years, where prices rose quickly and deals closed within days, but a slower, more grounded balance shaped by affordability, patience, and negotiation. Buyers who entered the market during this phase approached it differently. The expectation of rapid appreciation was no longer the primary driver. Instead, decisions were tied to long-term needs, financial stability, and personal timing. Sellers, too, adapted. Success no longer came from simply listing a property. It required strategy. Pricing had to reflect current conditions, not past peaks. Flexibility became essential. The willingness to meet the market often determined how quickly a home would sell. And so the slow exit continued, not as a single event, but as a process. A quiet withdrawal of urgency. A steady return to fundamentals. A shift from speed to caution. It did not leave markets empty. Homes were still bought and sold. People still moved, still relocated, still made decisions based on life changes, but the tone had changed. The intensity was gone. What remained was a market that felt more measured, more uncertain, but also more grounded in reality. In the end, the slow exit was never about disappearance. It was about transformation. Buyers didn't vanish, they became selective. Demand didn't collapse, it became conditional. The market didn't break, it recalibrated. And that recalibration, quiet as it may seem, is what defines this moment. Because in housing, as in most cycles, the biggest changes rarely arrive all at once. They build slowly. They settle quietly. And only in hindsight do they appear obvious. The exit was gradual, but its impact is lasting.